of Sales Chatter. So I'm pretty sure DJ will not be joining us today. He's having, hence the reason the show was not on yesterday. I had a bunch of doctor's appointments, so DJ and Jeff took the show, but DJ's internet, something is going on. I think he's getting the backlash of the Rogers issue that we had here a little while ago. So he said the technicians will be are on it, and the technicians will actually be getting it corrected hopefully by tomorrow. So hopefully by the end of the week, DJ's back up and running here.
Yep.
We're going to move some things around to make sure that we deliver for you guys every day, regardless of the internet issues. So there are going to be some changes, so pay attention to that. So you got the Deanster and the Dano today talking about, Dean, supply and demand, brother. It's going to be a really, really good show today, and I'm really looking forward to it.
Yeah.
To the HPLS podcast. Live, relevant, and high performance information, conversations, and education weekly.
Well, DJ did join us this morning.
From the car.
We got from the car, from the cell phone, but we got some bad internet there too.
Look at him go.
Oh yes, bad. It's gonna bad. I'm sorry, y'all.
Yep.
Oh, okay, yeah. You know, DJ, right now, I got to tell you, it's actually pretty entertaining. You look like the old ninja movies I used to watch as a kid, where they go, "I can tell you, it's going to be really awesome." And the voice comes on, and the voice, because none of your voices match.
You're looking for the subtitles.
I'm looking for the subtitles right now. Yeah. But good morning, Daman. Good morning, Jeff. Good morning, LinkedIn. So we got a LinkedIn user this morning, and we're not sure who that is, but we will figure that out. So, Dean, interesting what's happening in the market. And so here's my question: is before we unleash this to everyone, did you see this happening, or did you think it was going to happen a little sooner?
I didn't think it'd happen as fast, to be honest, because the rapid increase in diesel prices really accelerated things. So especially on the spot market. So that really was one of those wild cards that none of us saw coming, and that really sent the spot market into a tailspin. Not so much because there was basic fundamentals in the spot market had changed substantially. It was that the overarching volume of freight moving on contract freight had been, the underlying base price had been going up so much. But then as soon as the fuel surcharge went to like 74 cents per mile, which was like a double what it was a year ago, shippers started to say, hold on a minute, we're getting the full brunt of this fuel surcharge. How do we curb our procurement costs? And back in March, when that started, what we started to see was a consolidation of all those urgent LTL part loads that were going in the spot market last year. That started to consolidate those trailer loads, and volume started to decrease in the spot market almost simultaneously, maybe as a result of. So as soon as you saw that, volumes dropped, spot market rates dropped down about 30%, about 30%, 29%, 29.5%, so call it 30% year to date. But what's more interesting, I think, is that for our first time this year, our models are starting to pick up some increases in rates in the next 30 days. So they're starting to pick up a little bit of this back to school, Labor Day, peak season shipping volumes that we expect. So if you look at our forecasts for our short term, you'll see that they're pretty flat since July 4, which is really good news. Anytime you can keep spot rates reasonably flat after July 4, that's a good sign, because normally they drop. Right? Normally they tail right off in Q3. At the moment, when you look at our charts, they're relatively flat since July 4, which again is something that we predicted on this show a little while ago, that we thought that rates would kind of bounce around without any material change. And that certainly is the case since July 4. But just this week, for the first time, a little bit of upward inflection. So some good news there for carriers in the spot market. The broader news on the contract rate front, Dan, is that for the first time, spot rates have gone negative in terms of their year-over-year comps. So contract rates are starting to decrease. That means that all those RFPs that you've all been out there negotiating on behalf of your carriers, shippers, brokers, those new rates that are negotiated are starting to come into the big TMS routing guides lower. because there's a lot of rebidding going on, as we've talked about on previous shows. So those rates are starting to show up in routing guides. So they're rebidding core lanes. I think the bigger thing that people kind of misunderstand, I think, is the cost of changing carriers. I know Jeff Dickinson talked about this a little while ago, and that is it's enormously costly to change carriers just because of a cheaper rate. It has to be a substantial change. So the data we're seeing is that shippers are holding by and large with their core carriers. Maybe there's some rebidding and some adjustment in rates, but the rate decreases we're seeing are in the 8 to 12% range down. That's sort of the range that we're seeing at the moment in terms of how contract rates are comparing year over year, about 8 to 12% down. That'll continue, I think, for a little while, but I just don't see the doom and gloom and the pessimism that people are talking about. So that's sort of on the rate side. When you look at all the demand indicators, Dan, and of course, this could all change, right? We don't know how hard inflation is going to hit and whether this is going to sort of force us into another demand cycle. But right now, our demand signals are very strong. When you look at industrial production, even the American consumer is doing really well in terms of buying power. Confidence is not good. I mean, if you look at all the consumer sentiment indexes, they point to doom and gloom. But the basic underlying volumes that we report in truckload, whether it be, if you look at the ATA truckload tonnage index, up substantially. It was up 8% year over year, maybe not quite 8%. Let me get that right. It was, I'll get the exact number. It was 7.9%. So I was off by a point.
So how dare you, Dean?
Yeah,
how
exactly.
dare you not be off by a point on a live show?
But that's significant, right? That's significant that tonnage.
Huge.
Tonnage, that's the contract freight market tonnage, is up 8% year over year. I mean, think about where we were this time last year. We were in really uncertain times. So US Bank National Shipments Index up 2.3% this quarter compared to Q1. So
and you're talking like from a large global perspective, or at least North American perspective.
Yeah.
So if you're talking that much increase in freight, that's a huge amount of product that's gone up.
And I think, Dan, the bigger point is that, Jason Miller does all of this research, for everybody in the industry to consume on his LinkedIn page. And when you go back and look at his ton-mile index that he produces from 41 industries, it's probably one of the most reliable freight market indicators in the country. Is his Michigan State University for-hire truck tonnage index, TT mileage index, I think, TTMI. And it shows that not only are we doing well this year compared to last, we're actually doing slightly better than 2018. And I think that's always been the year that I've lent back on. We talked about this on the show last week as the most normal freight market year that we could compare to before things started to go crazy in terms of an up freight market. And we're doing better then. Everybody remembers how good in trucking 2018 was. And for perspective, our spot market looks a lot like 2018 did in terms of demand. But the problem for carriers, and I guess this is good news for brokers and shippers, is that the amount of trucks in the market resembles 2019, right? So that means we've got too many trucks. 2019 was an oversupplied freight market. There were too many trucks in the market, and that's what.
And shippers also got smarter. In shipping through 2018. Like I could share my customers. Our volumes dropped by towards the end of 2018, because at the beginning we obviously weren't really sure what was going to happen. And obviously, to two of your points, one, to change carriers is a huge cost. It really is. Not just a dollar and cents cost, but an image, credibility, and brand possible cost as well, because you're working the account. And yes, sometimes you might take certain things for granted, but you understand the way the business rolls, and you bring somebody in that doesn't understand it. And then there's this issue, that issue. So there's that image, credibility, and brand cost, as well as financial cost. And then you take into the fact that when 2018 hit, it was one of these things where, like, we sat down with customers. I mean, I tried to sit down with customers almost a year before saying, listen, ELD's coming. And I can remember some Magna companies were like, yeah, but we don't have to worry about that. And I'm like, well, why? And they're like, well, we're Magna. I'm like, okay, I understand that, but your volume of shipping, you have to worry about that more than the guy that ships one skid across Canada once a week. Like it matters way more.
Right.
So when all these things started hitting and all these costs started skyrocketing, it was probably May or June, so almost halfway through the year, by the time a lot of my customers came back and said, okay, how do we figure this out? And I was like, okay, well, one, we lock in pricing with carriers. We give them the business. Rates drop. We still give them the business because we have to develop and really nurture these major relationships. And I said, in second, we have to get smarter about how we ship your product. So I've shared the story where we were shipping transfers across. We turned them to rail, and we took an $18,000 load, and it started to go for $3,500. Actually, 66 because it took 2 containers to move the 110,000 pounds. That type of thing. And I see shippers going through that same process right now, where they're saying, okay, well, how can I get better at shipping? You mentioned something earlier where those expedited LTL shipments are now becoming a truckload. A truckload. Probably the last month and a half more than any other time since COVID, where shippers are finally saying, okay, like, what is my prime optimum shipping volume, right? And what I mean by that is for every shipper that's doing LTL, there's always a prime space that is the most profitable. So when we were dealing with a high-end vanity company in California, the first thing we did is we sat down because they were shipping 2-3 LTL shipments a week, but we're talking 10-12 skids. And I sat down and I looked at it and I said, okay, truckload is too volatile, especially out of California, because they didn't have the volume where you could keep a carrier busy, where they would say, okay, I'll lock you in at this rate. I won't bother with produce and that because you're giving me business all year round. They just didn't have the volume, right? Like a truckload a week is not going to get you very much clout with California carriers who are wheeling and dealing in produce and this and that, right? But what we realized was 8 pallets was the prime shipping, meaning every pallet, the cost per unit was so much lower at 8 pallets. When they shipped 4, because you have the premium of the 1 pallet plus then you have your 3. When it came to customs, when it came to everything, because we would do one manifest for the whole thing and we'd break the manifest up in Ontario and distribute it. That actually became their prime number to ship out of California, 8 pallets. Not only that, it was easy to book 8 pallets. 2 days later, book another 8 pallets. 2 days later, it was super easy, and it was such amazing transition to book that. And this is what I hear a lot of shippers talking about: is how do I get smarter at doing this? How do we do this? How do we make it so it's less headaches? And I mean, gosh, you think it's probably something that should have been discussed years ago. But again, right? I remember when COVID first hit me, I was like, this will be done in 6 weeks. I literally, we had a conference coming up, the High Performance Summit, the High Performance Logistics Sales Summit was literally scheduled 3 weeks after they declared a pandemic.
Right.
So we had people flying in from New Zealand, from the US, from Western Canada. I had all these speakers lined up. There was 300 and something seats sold. And it was 2 weeks before we were on stage, it was pandemic, everything shut down. So what we did is we just moved everything 6 weeks. And then we moved it again. Then we moved, I moved the summit. Everyone that bought tickets was probably at one point God Lord, does this guy even know what he's doing? But you're moving it to 6 weeks, 6 weeks, 6 weeks.
Yeah.
Trying to get in that, trying to keep that momentum and trying to keep that energy alive. And we ended up, anyways, it ended up going from literally March all the way till December of that year.
Right.
And it ended up being virtual as opposed to in person, right? So there's all these things that change, and it's how do we swing and adapt to it, right?
Yeah. Yeah, well, the change is underway, that's for sure. I did want to share, I'll just summarize while we're on this sort of contract rate side of the market, because I think it's important. And I do want to share a data point from Jason Miller about business applications, which are new business, new companies coming in, applying for new businesses and getting their EIN numbers. He's got some fascinating data out, but some of the data we've got from our shippers, if we could just talk about general trends with shippers, these are obviously the folks that you're negotiating capacity with. So a lot of the contract rate negotiations are already underway. The annual RFP is one method. Some are doing some smaller mini bid carve-outs on core lanes where there's high volume. Remember, in our business, our contract freight market represents about 40 billion in freight spend. About 80% of the volume of loads move on 10% of the lanes. So there's a lot of density around some of these lanes with the very big shippers in the country. They're doing some soft negotiations with core carriers, as I mentioned, 8 to 15% contract rate negotiations or reductions for the incumbent carriers. Shippers are using the softer market conditions to optimize their carrier roster, making sure they've got the best carriers with the highest service levels. That's something Jeff talks about a lot. The price is one thing, but service levels are another when it comes to trucking. They're also taking a surgical approach to this. They're using lane-specific benchmarks to identify and quantify opportunities. They know that the cost of carrier churn is high, so they're staying with their incumbents and generally looking for the next market cycle. One of the things that we've always seen with shippers is they're always and if we could use that ice hockey analogy, and I'll probably get this wrong, but when they're always sort of playing where the puck is rather than skating to where it will be, which was, I think, a Wayne Gretzky comment, if I'm right.
Well, Wayne Gretzky had said you always play to where the puck's going to be, not where it is.
And when you think about where shippers typically think about rates, and a lot of people in trucking for that matter, they're always thinking about where rates are based on where the puck is, as opposed to where the puck's going to be. So if you've got to be pricing yourself for the next market cycle, and because annual RFPs are going to extend well into next year, which is probably going to span the bottom of the freight cycle that we're in now, and then the next upturn. So shippers are thinking, okay, what's the longer term play look like here, and how do we do what we've always said on the show, and that's leave something in it for the next person, which is making sure we've got a fair rate, it's a fair price, but we've got good service. Getting good service levels is very important because
everybody's making money, so they don't go out of business halfway through the negotiation or the
right.
finalization. Yeah.
And then when you look at the other side of the coin, which is the carriers, if you've seen the earnings calls in the last week, simply amazing. The profit, income and revenue growth from the truckload carriers in the earnings calls are simply amazing. So that confirms what we've been saying for a while, and that is that carriers are having a very good financial year so far. They had a very good financial year last year. So some of the earnings calls are really reporting good profits, but also a very interesting outlook. They do see some softening in freight demand, lots of volatility, but nowhere near the decrease in demand that some people in the media are forecasting. So now, of course, we could all be proved wrong by something unforeseen that happens. We don't know where this is going, but as we sit here at the start of Q3, demand looks really good for truckload carriers, and I think that's meted by the fact that there is some constraint on capacity. It's still, they're still not getting all the trucks out of factories that they would normally get for their trade cycles. So that's helping somewhat. But there is still considerable growth in the trucking industry, and that leads me to Jason Miller's piece. And there's some fantastic numbers that come out of this. And I'll just quote you. So these are the EIN number requests. These are business application requests through the Census Bureau's Business Information Statistics Program. And of course, they've been declining over the last few months, which you'd expect in truck transportation establishments. So for context, applications in June 2022, so last month, applications for EIN numbers were 32% above the 2017 to 19 trend line. So within that trend line, there was, in 2018, of course, the EIN number applications exceeded the trend line because a lot of people joined the industry in 2018, whereas in 2019, the number of new entrants was below the trend line. So that kind of speaks to the veracity of the data. So June just gone was 32% above the 2017 to 19 trend line. Now, truck transportation establishments represent about 55% of all establishments at the moment. Back in 19, it was 53%. So I think that just says to me that if the number of people joining the business is still, they're still expanding. So payrolls are still expanding. In June, I think it was up something like 20,000 new applications in June was the number. So it tells me that we're not seeing, and even on DAT's business, we're still seeing people join the business. We're still seeing new carriers requesting authorities. Now, there are carriers leaving the industry too. So when they leave DAT's network, they leave for a number of reasons. They stop hauling freight, park their trucks, sell their trucks. Some unfortunately do go out of business, which is a tragic outcome. And then some others just park their trailers and go and lease on to another larger carrier. So we are seeing some movement in that. But what's surprising me is we're also seeing new people enter the industry. So I think there's still some positivity, even though there's lots of doom and gloom in the market. We're actually seeing a pretty good outlook for the second half of the year. So at the moment, Dan froze. We've lost Dan. I don't know whether I'm the only one on the show or not. Oh, Dan's gone. This is awkward. It's probably just me on the show. Anyway, I'll keep talking as if I'm the only one here and Dan's going to come back in and join us shortly. We've got some serious issues in Canada by the look at it, in terms of, lots of owner-operators decided to open companies to try to take advantage of higher rates. Yeah, that was certainly the same thing we did. Yeah, thank you for the LinkedIn user telling me you can hear me. We talked about this on a show a few months ago that we're seeing a repeat of 2018, 2019 freight market. So remember in 2018, spot rates were high and everyone went out and bought new equipment. We had record numbers of new trucks ordering in, I think it was maybe September, October period in 2018. And then, of course, there was this mass bleed off in capacity in 2019. Our biggest fear was that we would see a repeat of that. We haven't this year. It hasn't happened. Bankruptcy numbers haven't emerged yet to show that we're seeing anywhere near that cataclysmic outcome that we saw in 19. And I think the biggest thing that folks are missing in the market is carriers had such a profitable year last year. We talked about it on the show a few months ago, and we sort of predicted that we're not seeing the doom and gloom scenario because carriers are coming off their most profitable year in history. One of the leading financial analysts said that they're coming off one of their best years since deregulation, basically, sort of 3 decades ago, maybe more. And that has put carriers in a really good position. Now, I'm talking about small carriers. The average net income of owner-operators and small fleets last year was $70,000, according to Todd Amon over at ATBS in Denver. Now, he's an ex-large truckload carrier and one of the premier financial services guys in the country. And that's a really good benchmark to follow, atbs.com, if you're not following Todd Amon. So then we fast forward to this year where we're now starting to see some of the earnings calls produce incredible results. So truckload carriers are in pretty good position, especially the contract carriers. They've got a fuel recapture program because contract rates have never been as high as they have been right now. Dan's back.
There we go. And you know what? That was the weirdest thing ever.
Wow.
So you went dark on me, and
Yeah.
I've lost all of the chat. Okay, I see nobody in the chat.
Yep.
Your internet bar just disappeared, and it's still gone.
Right.
So you have zero internet, but yet everything went dark on my end. It said connecting, and I'm sitting here going, "What is going on?" I'm looking over at my router, and I'm like, "Okay, Roger's still up." I'm thinking,
well, you know what was funny? You froze with your eyes closed, looking at the camera. And I thought, "Oh crap, Dan's fallen asleep." So I kept talking, thinking he's got to wake up any minute. He's got to wake up. I thought, oh no, he's having a microsleep. Oh shit! Like, is his head going to hit
I just
the
developed
table?
narcolepsy along the way.
Yeah.
Like, you know.
Well, I immediately thought treatment.
You get narcolepsy with it.
Well, you were saying before the show that you don't sleep well and you're having all this treatment. I thought, oh no, this is awkward. So
well, I have been up since about 2:45 this morning, so that's interesting. So for all y'all, I don't see any of your chats for some reason, and I really apologize.
Power nap.
LinkedIn user says power nap. Yeah, one of those. You know when you're in the middle of a conversation.
Yeah.
Okay, we're back. You know what I mean?
Yeah,
But
yeah.
so I apologize, everybody. There was a couple of people that were. It comes with age, Dean. Laugh my ass off. Nice,
Yeah,
Jeff. That's
exactly.
nice. Sorry, everybody. I don't know what happened there. I thought Rogers let us down again, so hopefully they were able to get all the 911 calls because
Yeah.
that was a huge issue. That my sister-in-law works as a 911 dispatcher,
Right.
and she said you should have seen it when the Rogers lines went out.
Oh.
Like everybody at 911 is just looking at each other, going, "Something's good," because they're not allowed their phones or you know what I mean, like at their desk, right? So it's literally just the desk. And she goes, and it was like ring, 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 and she goes, it was the eeriest feeling ever. It was like no phones ringing, and you're in the middle of one of the busiest 911 dispatch centers, and her center dispatches for like Markham, Ornamente, like all these different places, and they were in the middle of a major structure fire call. There was some things happening, and she says it was just. She goes like, you've never seen panic set into people like you did. I mean, there's 911 operators that are on the phone with people that are in a burning apartment building trying to talk them down while the firefighters come and get disconnected. Like, can you imagine that? I mean, I don't know, man. That would be crazy. That would be crazy. So what were you getting at? Because where I lost you was with Jason's touch points.
I was doing a bad job at filling, wondering what the heck am I going to talk about? And
Dean, it's funny you say it because I was doing the same thing because I'm thinking I'm live and you're gone. So I'm like, oh, Dean's gone. Let's just address some of the questions. And I'm going through some of the comments and I'm not even live. That was hilarious. So I'm sure you did a great job.
One of the things that we've seen in the last few months is that there's been a shift from spot back to contract. So, higher rates in routing guides encourage large carriers to reject fewer loads and accept more loads. So remember, a year ago, carriers were rejecting about a quarter of all loads tendered on the contract market. That's down to about 10% today. So acceptance rates are very high. Why wouldn't you? Rates have never been as high as they are. So
didn't the shippers also, though, because we talked about this before, didn't shippers also say, okay, we'll agree to some higher rates, but you got to stop rejecting the loads. Like we get agree to higher rates, do your job, and pick up the freight when you're supposed to pick it up. Because I'm sure there was that conversation, right?
Yeah, higher levels of service commitments, and that's why folks will be finding it hard to offer rate reductions. Asking for rate reductions on the chance that it compromises service. So there's a delicate balance between service and price and available capacity for each of those shippers. So we're seeing more of a 90-10 ratio, 90% contract, 10% spot versus 75-25 this time a year ago. So the spot market is definitely weakened, but always remember it's the smallest part of the freight market, but for a shipper it can be the costliest. But right now that's not the case. There's obviously savings to be made by moving freight on spot market. And the trend that we've been seeing is that shippers are being very selective about their bids now. Instead of bidding out 100% of their lanes, they're only bidding out a certain selection of the lanes because as at the start of the show, we said that, most of the volume moves on a small percentage of the lanes and they're leaving that excess volume that they're not putting into the RFP go to the spot market. So we're still seeing healthy volumes in the spot market. Our data shows that, and I'll just pull up some stats here, our load post volumes are back below 2020 levels for the first time in dry van. But I think the carrier equipment posts is more concerning. Carrier equipment posts last week were the highest we've ever seen in July. So a carrier equipment post is where a carrier is posting their equipment on our load board searching for a load. That's the opposite of a broker posting a load looking for a carrier, which is a measure of demand. So we're seeing carrier equipment posts at the highest level we've seen for July in dry van and reefer, but in flatbed, the highest level ever. So because flatbed has cooled off substantially, right, because the steam has really gone out of that market rapidly. There's definitely cooling off in the housing market, as we've talked about. So that market is softening. There's a lot of softness in the rates. There's a lot more room to go down. So remember that capacity looks a lot like 2019 levels in terms of carriers posting their equipment. Low rates is going to force that migration of carriers over to the contract market and work for larger asset-based carriers to keep the wheels turning. There's still opportunity out there for small carriers, though, and they're still seeing opportunity to join the industry and do well and grow their businesses. So it's a precarious time, and I think the broader macroeconomic issues are the ones that sort of weigh on my mind heavily, because I just don't know how much that's going to impact the people that buy things that we haul freight for, which is kind of all of us. But in the last 2 years, the resilience of the consumer, the spending power of the consumer has continually proved me wrong. And despite high inflation numbers, we've still got pretty good retail sales numbers.
It's it's the spot market and the posting of equipment. You see that when it starts turning into a shipper's market, right, where rates start plummeting and all that kind of stuff, and there's so many trucks. Does that correlation happen? Like, do you see that correlation with the new companies that came in, or it's just what it is when it comes to this market, Dean? Like, what is kind of that? Can you break that down in those percentages?
No, not really, Dan. It's kind of we look at load posts and we can't pass it out by tenure in the industry, if that's what you're getting at. Like, is it just all new carriers or old carriers? Because in our network, we've got a wide range of carriers that have been in the business for decades, own their own truck and trailer, right through to a new guy that's running power only loads with a used truck they've paid a lot of money for and have been in the business 3 months. So there's a wide range of carriers that we have in our network. We kind of look at it from a total market perspective. But and I just saw one of the comments in there with Jeff. The thing that we saw is that wide
this one here,
even though rates are have been trending down to flat and possibly heading up in the next 3 weeks, on some lanes there's the exact opposite of rates going down. Spot rates are still going up on some lanes where there's a capacity imbalance or an outbound imbalance where it's produce related or something seasonal. So we're still seeing pretty good. I mean, for example, when I looked at all the produce haulers hauling literally just loads of fruit and vegetables out of Fresno, they're averaging $4.45 a mile all in, compared to the national average reefer rate of $3 a mile all in, including fuel. So, and that's because it's specialized equipment. A farmer that's harvested 40,000 pounds of strawberries over the course of a week is not going to put that on any carrier, especially the smaller growers. They are very particular about who they use. A lot of those growers have carriers that they use year in, year out, and those rates come with a premium because you've got to get it there on time. It's a particular service level you've got to be able to offer if you're in the reefer space. So that attracts a premium. So specific lanes for specific carriers are attracting a premium, and and I think we'll still see that across the market. There's always opportunities out there for carriers to do well on certain lanes, even though rates are generally trending down.
Got it. So what is your what do you see happening over the next kind of 2.5, 3 months into October? And then what do you see kind of happening moving forward towards the end of the year?
Yeah, we're in this. I think so. If you talk about rates, I think spot rates are going to remain flat. They'll probably go up. They could go up a little bit, but the forecast is saying they'll go up. I think they'll actually more likely stay flat between now and you get into Labor Day and you start to get into that time of the year when more freight starts to move in peak season. So once you start to get into that September, October timeframe, I think you'll start to see rates start to increase in dry van, not substantially. I mean, we're not talking about huge, licks of change. We're probably talking somewhere in the range of 5 to 8 cents per mile. The dry van, that's the dry van sector. Reefer sector will definitely, it has some surge potential around Thanksgiving. So you'll start to see fresh turkeys moving 3 weeks out from Thanksgiving. So you'll always see, Joplin to Chicago, Joplin to New York City, You'll see lots of demand out of those outbound markets where there's not a lot of inbound freight. So shippers will pay a premium to move those loads at those times. So I think there'll be some normal seasonality, is what I'm saying, Dan, in dry van and reefer. This is not unusual seasonality to see rates cool off, remain flat between now and Q3, end of Q3, and then start to have a little bit more volatility and uplift. But then they'll cool right off next year. And I think the wild card that we're sort of watching is the impact of the port disruptions, the labor negotiations. People keep talking about how improbable it is that there would be a rail strike. Yet the more things go on, the more people are concerned that it could happen because labour negotiations have never been as bad. Great article in the Railway Age if you want to learn about the railroad strike. So, yeah, I still see, flat to increasing demand is how I would put that, Dan. I think there's going to be pretty good demand signals for the rest of the year. This is normally the part of the year where you start to get into peak shipping season. Right?
Yeah, which has kind of been distinguished. It's been defused over the last couple of years because of supply and just get it in when you can.
Yeah.
Now, so we got a couple of questions, but before we get to the questions, it's interesting because if we're talking 5 to 8 cents a mile, right? Where we're at right now with that market, that spot market, we're still above where we were a year and 2 years ago, correct?
Yeah, we are way above. We're even 29 cents a mile above where we were of all the pre-pandemic years. So
I mean, we're still, spot market rates are still much higher, and if you're 29 cents above, then you add another 5 to 8 cents. We're still well above where we were, call it 2017 pre-pandemic, right? Because 18 was the spike, 19 was kind of like that cool off where everybody came in and rates dropped, and then obviously 2020 with the pandemic.
Well, we're 4 cents above where we were in 2018, right? 4 cents above.
So, and 2018 was that year when everybody's sphincter tightened right up, and they were like, "What the heck is going on here?" Right? For sure.
Yeah.
So
reefer is exactly the same as this time in 2018 at $2.18 a mile. That's excluding fuel. Flatbed is 8 cents per mile higher. So yeah, we are better, same or better than 2018 for mid-July or third week of July.
And 2018, I remember when I first met you in 2019, 2018 was that year that everyone was saying you can't do comparables to 2018. Like it was such an anomaly, you can't do comparables. So it's interesting now because now that is the benchmark. Right? Like that's when we're talking about this rate increase and this holy crap, rates are insane. It's like, well, where are they compared to 2018? Because in 2018, that was like the highest hike I'd seen in all my years in the industry with rates. So it's interesting how the data sets that we use change.
Well, you asked last week why 2018, because there were things happening in 2018 that were unusual. And of course, the pandemic has been more than unusual. So what year do we compare it to? We had, and I'll quickly repeat them, late 17, 2 Cat 5 hurricanes, early 18 changes in the tax code, accelerated depreciation. A lot of people bought more equipment. We had an oil price rally. We had a lot of economic stimulus in the industrial economy, things happening in the freight market that don't normally happen. And of course, you fast forward to, and then 2019, carriers were still shedding capacity all the way up until March of 2020 before the pandemic hit. Like that was a long period of time when the market was in a downswing. And then, of course, what year do we compare the last 2 years to? And when you look at the data,
can you compare it to anything?
It's almost impossible. But the seasonality of it looks a lot like 2018 did. When you look at all of our charts, it looks a lot like how the market behaved in that period of time. So
it's interesting because a benchmark that people would say you cannot use this as a benchmark has now become the benchmark.
Yeah, and that's why that's sort of our view of the world at DAT, right? It's probably a third of the truckload market that we're talking about in terms of the number of loads we see through our network, and we've got 150,000 carriers on our network. It's the largest freight network in the country. So we're seeing, pretty good market behavior. We're not seeing all of it. We're not claiming to see the entire market like some, but we're seeing a decent chunk of the market.
I love
So
it. I love it, Dean.
so
I love it.
yeah,
Let's
I
get to
think
some of the questions here.
yeah.
We've got Adenola. How are you, my man? I hope you're doing good. Which is better? Better dedicated rates or spot rates?
That's a really good question. I prefer dedicated rates because if I'm running a trucking business, I like predictability and I like to be able to run forecasts and I like to know what my margins are so I can plan ahead with my my acquisitions, my equipment replacement cycles, staffing levels. Dedicated rates allow you to lock in that. Dedicated has become very popular, of course, in the tight capacity market. We'll see a swing away from dedicated back to more spot market activities, I think, when the market loosens. That's a normal market behavior. But you could also offer the counter argument and say that when spot rates are at record highs, spot market would be a better opportunity. But I think longer term dedicated rates where there's more certainty and predictability would be my preferred option.
And I think from a shipper perspective, I'd probably prefer dedicated over
Yeah.
spot as well, because again, like you talked about, you can determine profitability. You can understand your cost per unit to ship. You can understand all of it. And I do agree with shippers maybe taking some of those less than high volume lanes. I guess I don't even know if that's the proper way of saying it, but the lanes with really low volume and putting those to spot market as opposed to contract, because you're going to pay a higher contracted rates for those. But I would see from a corporation perspective, from a department perspective, if I could build a well-oiled machine to get my product to market for my customers, it's all going to be automated and dedicated. To me, it's the automate, delegate, delete theory, the ADD, and all the way in every single company and everything you do, automate, delegate, delete. And if you can automate your shipping, and I'm sure you ask 10 different shippers and they're going to say, yeah, if I had a network that was able to just like clockwork run, it would make their life so much easier, because now they can put out those fires that they typically can't put out unless they do it. So great answer. Jeff says, Dean, do you think that more imports will hit the port of Houston, Savannah, New Jersey, New York over the next 3 months and see a dip in LA and Long Beach?
I think the answer is yes. Current trends are pointing towards that being the case. A couple of things going on. Of course, you've got industrial action on a couple of fronts. Well, not industrial action. You've got the ILWU contract is still being negotiated between the port workers on the West Coast and the ports that run them. So we've still got the waterfront workers to have that agreement ratified. And then, of course, we've got the AB5 problems going on in California, where you've got a lot of carriers have been blockading the Oakland port for all of last week, I think it was. So there's still a lot of unrest going on the ports. I think that is what shippers saw coming, and they started to shift different volume away from there. And the numbers show me that year over year, East Coast volumes are up 5% year over year. West Coast volumes were down 1% year over year. So there is still this ongoing shift from the West to the East Coast and the Gulf Coast. Gulf Coast volumes were up 3% year over year. Sorry, so I was reading month over month. Year over year numbers. So this is to amplify the shift from the West to the East Coast. East Coast year over year volumes are up 12%, Gulf Coast up 9%, West Coast up 5%. So we're seeing more volume compared to this time last year shift to the East Coast ports, but that's also causing this big backlog of vessels off Savannah that you're seeing because of the congestion that's been growing on some of the ports like Charleston. Ocean carriers have been changing their destinations and getting out of sequence into the ports to get things unloaded to avoid congestion, and in the process creating more congestion at other locations. So West Coast congestion has eased right off. It was down in the low teens last night from the last report. I counted on Monday 43 vessels off Savannah. These are cargo container ships, not tankers or anything else, just cargo ships. So 43 waiting to unload in Savannah. So I think the answer to Jeff's question is yes, we're seeing much more year over year volume. And yes, he's right. Savannah volumes up 24% year over year. Norfolk up 20% year over year. Charleston up 2%. Vancouver down 14. So yeah, we're seeing a shift in that volume. I think that'll continue as the labour unrest continues, because shippers are now in the phase where there can't be any doubt that they won't get their imports in for the upcoming back to school holiday season. Like we're already almost at the start of August, so there's no time left. So I think that answers. I think it's already happened. The shift.
Daman says, keep in mind, I believe both 2018 as well as recently, the driver wages have increased, plus equipment pricing skyrocketed as well.
Oh, yeah.
Yeah, I mean, and huge. I mean, 2018 was the big year where a lot of people I know that own trucking companies actually went from per mile to salary for drivers.
Yeah.
Salary plus bonus, which actually created a pretty big uptick in their overall cost of operation. So some of them were at like 88% and shot up to 96% operating ratio, right? And just because of that driver wages, and you're right, Damon, to replace your equipment was costing you an arm and a leg over the last little bit compared to what it used to cost, right? A lot of companies also said, I'll stick with my equipment for a little more. I mean, I was having a conversation with a friend of mine that owns a company, and he was like, I'm looking at the cost and what I can get for all my equipment. He goes like, I'm thinking, man, if we got 10, 15 trailers we don't really need, let's just get rid of them. Because he goes like, I can make a profit. I've had them for 3 years, and I can make a profit on getting rid of them. And it's, so then that conversation starts hitting, right? Do we sell the excess 20 trailers that we don't necessarily need?
Yeah.
And then it's like anything else, right? You ever cleaned out your office or your garage, and all of a sudden the day after you cleaned it, you're like, damn, that piece of wrought iron that I had, I could really use that right now. I could have welded that to that and made that. And for me, anyways, it's every time I get rid of something, I find I need it like 3 days later, right?
And you can't take those wage increases back. So a lot of those are embedded in the current operating costs. Absolutely.
Yeah, we got a lot of people here. This is crazy. So awesome, everybody. Keep it coming. Dedicated for sure. As a carrier, I would assume there's still great money in transactional freight. As a shipper, as Dan said, dedicated for sure. That's Scott. Samantha, how are you? She says shippers need to be wary of low rates brokers are offering in an RFP for contractual award. They plan to cover the business at a true spot rate, 200 annual loads with 200 different carriers. If the spot rate changes, it's not sustainable, 100%. Damon says, I've noticed that shippers are moving towards asset carriers to reduce their volatility and to secure direct capacity. They are. There was, and actually it's funny because Samantha's coming back pretty much to say exactly what I was going to say, that massive shift in 2021, brokers are becoming too attractive that I'm seeing large shippers start to balance more in brokers again.
Yeah.
And it was, there was, when this first happened, there was that switch, right? Because it was like, and again, I'm going to call some of you out there here. It was the shit brokers. Like, and again, Dean, you know me, I'm all about calling a spade, right? It's the brokers that said, I have capacity, I have trucks, and they're just going to try and find something on DATS load board or ITS or something. Right. And they don't really have trucks. They don't really have the relationships. And that's what really gives all brokers a really bad name, right? Like you find 10,000 people that deal with a used car salesman or buy used cars, and they have no problems. But that one person that has that snake oil used car salesman, everyone hears about it, right? And it's like everything. If you know somebody that gambles, you don't hear when they lose money, you hear when they win money, right? So we only hear a certain side of that story.
Right.
And this is what I found in my years in the industry, is listening to salespeople. And in my head, I'm going, you don't have a truck. I mean, I remember being taught that way. Yeah, we got trucks in your area. And I remember with Plusmark hanging up the phone and looking up at my buddy and saying, I just got 5 loads a day for the next 6 weeks. And literally everybody in the development center I was in jumped in to help me find trucks, because I said I had trucks. Not that I will find trucks. I had trucks waiting. And it's like, now you have to make sure that you come through on that lie.
Right.
But that's what, when you can't, especially in today's market, very difficult to come through on that. It gives us a bad name. And you're right, Samantha. It's they're seeing the attractiveness of brokers, and then the brokers are letting them down. I mean, you talk to Greg, you talk to a bunch of people that we bring on the show, and they're like, "No, I've gone asset just because of visibility, because I was told one thing and given another." And we're talking with, major third-party companies, like major 4PLs that are just dropping the ball, trying to keep business.
Well, Dan, I see this. This is sort of a delicate balance that people play between the contract and spot market, and people looking to, Daman makes a good point that shippers naturally tend to gravitate back towards asset carriers to, make sure you maintain that service. A lot of people have been playing the spot market and doing what you were talking about, sort of thinking that I can get a truck at any price because there's a level of desperation out there. Diesel's down 51.5 cents in the last 4 weeks. And what you'll start to see, just like as diesel went up and spot rates went down, as diesel comes down, that downward pressure on spot rates will start to disappear. Because diesel has been, in the last 3 to 4 months, one of the biggest drivers of spot market rates by far. So and I think that's partly why we're starting to see a little bit of flattening out and upward lift in spot rates, because diesel prices are coming down and forecast to go lower, according to the EIA. So different conversation.
What is creating that? What is creating that the pricing of diesel going down? Because where we are in Ontario, right? So when before the government implemented tax cuts and stuff, and the Ontario government said we're going to cut it, and it's going to be like 11 cents a liter. Like, we were up, when you do the conversion from liters to gallons. Now Canadian money, so then you got to convert that to US money, right? So your 1.3128 exchange. Right. But we were up well over $9 a gallon. Well over $9 a gallon, and it's come down. And I know we've had this conversation before, but it's funny because I'm driving yesterday on the way back from the hospital, and I see a 163.7, and I'm like, oh my gosh, gas is so cheap. Well, it was like 120 like 6 months ago. You know what I mean? So, but when it's 220, 163 seems really cheap, right?
Right.
But they said it's for 6 months.
Right.
Like, we're going to do this for 6 months, and then we're going to see where it goes. And I've never understood this. One gas station is 163, or one gas station is 330 a gallon, and like literally 2 miles down the road, it's like 380 a gallon.
Right.
And it's never the same. And I mean, there's gas stations sometimes across the street that have 10 cents, 20 cents difference per gallon.
Right.
Right. So what are you seeing in the U.S. as that factor that's driving fuel down? Do we know?
I have no clue. I'll be honest. I have no idea. This has been one of the more difficult things to try and figure out. Obviously, it's supply, right? There's a supply issue overall. I think the world is trying to figure out how do we find, I think it's 6 million barrels a day that Russia produces, that how do we find a backup for that? The Middle East companies, OPEC companies, are increasing, capacity, but that can't come on quick enough. I just noticed last week we're drilling as many oil wells as we did in the peak during the previous administration. So the number of oil wells being drilled is coming up. That capacity will take a while to come online. But there has been a big disconnect between the price of West Texas Intermediate, like the crude oil, and the retail market. And the retail market was slow to go up, and it's slow to come back down, even though the national average this week was down at like 548, something thereabouts. The price at the retail outlets will take a while to come back down to reflect that at your local gas station. So, Dan, I haven't been able to find a decent answer to that, because every time I read about it, there's so many different things going on to explain the market. They seem to change every week. So I'm not even going to have
it used to be pretty simple. The cost of a barrel went up over $100, then things started to happen. When it went down under $100, things stopped happening, and it was very linear. I always found over the years, when you look at fuel prices, everything was linear. Like, the cost of a barrel went up, then our price went up. And now it's like the cost of a barrel went up and then it dropped, but our price stayed here.
Right.
And it's like, it's kind of like wood. Yeah. Right. And I guess my question then starts to revolve around, if anyone knows, or if anyone has data on it, please share. It's like, okay, we understand wages have gone up. We understand everything's costing more. So maybe insurance is costing more. So maybe this is where the price stays high, even though the raw product comes down. Mm-hmm. Speaking with a buddy of mine at a major paint company, they put out in 2021, they put out 3 rate increases to their customers.
Right.
And I said, what is it for? And he says, Dan, even if we find the material, like, we're talking raw product, dyes, all this kind of stuff. He says it's costing us twice as much to get it to where we need to go. Not only that, our cost is almost twice as high from wages going up and all this kind of stuff. And he says, so like everywhere we go, there's a price increase in behind the scenes. And he says, and it's driving our price up. And he says, and after 2020, you know, our mission for 2020, or after 2021, our mission for 2022 was profit. We want to be profitable again. Right. And we're talking a multi-billion-dollar corporation, like, you know, double, triple digit billions kind of thing.
So Daman touched on something a little bit a while ago there about, you know, knowing operating costs. And I did some analysis. You know, that spreadsheet I've been running of that mythical truck that runs 110,000 miles a year, and it's a true long haul owner operator truck. So, you know, last time line haul spot rates excluding fuel are identical year over year, but there's almost a $2 swing in diesel prices. So when you break it all down, if you take out fuel in terms of what it costs to run a truck, it's about $1.24 per mile on this truck. And I know there's no right answer with this because everyone's got different operating costs. But a year ago, fuel was 51 cents a mile. Today, it's 81 cents a mile. So my total operating costs a year ago were $1.76 per mile as an owner-operator. Today, it's $2.05. Now, the caveat here is that I'm paying myself a wage. So I'm running this truck as a proper business. I'm not cutting corners, paying all my bills. I've got all my permits, paying finance, and I'm paying myself $70,000 a year wage, right? And that's in the $2.05 a mile, because you can't say, oh, we'll take that out and we'll figure out what the rate is. No, that's not how it works. But what some carriers will do is they will reduce their drawings to lower their operating costs. And unfortunately, that's not good longer term, because what you're not doing is getting any return on the equity that's employed in your business at all. So that same truck was $1.76 a mile a year ago, $2.05 today. I mean, that's down almost 10 cents a mile since diesel has started to back off. So operating costs for carriers will improve as diesel comes down, but don't think that, you know, you could buy a truck for $1.50 a mile and think they're making money. They might be making money on that trip because they own their own truck. They don't have any repayments, but that's false economy because you're not getting any return on the equity that's in that vehicle. And that's a long-term plan to disaster.
That's interesting. Daman says, if a broker would actually take the time to understand a carrier's cost, brokers would actually form great long-term service relationships with shippers and carriers. These brokers that try to underbid rates are the ones that ruin it for us all. 100%. Yeah. I'm pretty sure that's what you were just referencing there. 100%. Jeff says, as you know, Dad, I love to say no. I don't have the cheapest rates either. Do I? And you're not God, so you can't guarantee capacity. That's true. You can. Daman Grohl, Samantha says, Daman Grohl, it's common sense, isn't it? Too bad not everyone has it. You are 100% there. And, you know, Samantha, I'm going to go even further than common sense. I think it's along the lines of, if y'all have ever seen those people that get on the road and they just have no clue that anyone else is on the road. It's like, I'm the only person here, so I own the road. Or at least you get that feeling when they cut you off in traffic kind of thing. It's like, oh, I have to move over now, so you can just, you know, stay where you are and I'm going to go over. And I see, you know, the common sense piece of it. I actually see most companies not teaching their salespeople this, right? And when we come into this business, and I don't know about all of you, but would love to hear. When I came into this business, the sales trainer was sitting down with other sales reps. And you start to see a pattern where it was maximize profit per load, maximize profit per load, maximize profit per load. And there was no talk, at least when I started, ever, of dedication, partnerships, relationship. It was like, you know, Polaris Transportation, they're awesome at LTL. Just give them the freight, they'll do it. And they do a good job. Some people believe they do good. Some people hate them. But there was no relationship. It was all just done digitally, and you send an email and somebody from customer service sends you back. So it's very transactional. And it's when you make that flip, like Daman said, to that relationship driven. Like, one of the things I've shared with many, many, many students is when you come into this business, don't just start calling people. Talk to your supervisor, talk to your manager, talk to other salespeople, Get 5 to 10 suppliers that your company loves and trusts. Sit down with them and sell for them. Only them. Meaning if you're selling for a supplier that's Kentucky to Chicago, and this person says, well, I do Kentucky to Oregon, say, thank you very much. Have a great day. When I can get that lane with my select 10 suppliers, I'll call you back. Right now, I'm looking for this. And be that direct. And a lot of brokers are like, Dan, you're crazy. You're leaving money on the table. Yes. But would you not rather design a career around your life and have a career that when things in the market happen, when economic drivers happen, you can remain sustainable, and you're not fighting to feed yourself. Do you know what I mean? There's a big difference. And if we just get that concept, it would change everything. It would change everything. And, it's true. Relationship is the key, right? So, or Jeff, I don't know, we're getting short on time. Daman, I could not agree with you more. I know what the carriers' costs are. That's what I preach to my customers and other brokers. Wake them up. Been in the industry for a very long time. Check out my profile. Scott says, Daman Grohl, the successful sustainable brokers are doing just that. Goes back to proper training and development. That's exactly what I just said. Yeah. As a carrier, we'll take losses on loads just to move a truck. If we can run 10 decently to take out a loss of 1 to 10, we'll do it to keep our drivers happy. Sometimes we do it just to help out our customers. Most carriers I know are flexible. And that's so true, right? But that's the relationship. You have the relationship with your customer. It's a give and take. I mean, I don't know how many times I've said to my suppliers and my partners, I've said, listen, what's your rate on this? Well, my rate's $2,500. Okay. I got 22 in it. That's what I'm charging the customer, but I'm going to give you 25. I know you need to get it done. I just need to get it moved to save face. And I've lost $300 just to save face, like Damon's talking about, to help, right? As a broker takes one of two approaches. Your carriers are your product. Without them, you have nothing. Understand what they want and need and make it happen. Yes. Focus on rates. Take advantage of carriers. Shame on them for not knowing their costs and how to get profitable business. This happens every day. You just talked about $2.05 a mile. There are spot rates posted every day by brokers for 98 cents a mile. And that is actually friggin' disgusting.
But then, on that, as a carrier, you'll take wins and losses, because I might have to run for, $1 a mile, but I've got to get to a market that might be $3 a mile. So over the time, I average at 205. So you're always going to have wins and losses on lanes. But if you can average 205, then that means you'll be profitable long term. So, that's just the imbalance in the market that we're seeing right now. But unfortunately, some carriers don't know their operating costs. And Samantha is exactly right. Shame on them for not knowing.
Yeah. It's like the time I asked an owner-operator at Transcend, I was like, well, how do you know you're making money? He goes, well, I have money in the bank.
Yeah, right.
We talked about this when we talked about your friend that blew his engine. And now, he's a huge amount of money into
grand.
it. And 85 grand. And it's like, okay. So how many owner-operators have 85 G's in the bank?
Good question.
Right? Like, think about this for a second, right? So I asked him, how do you know you're making money? He goes, I got money in the bank. What is money? Right? Some people, 10 grand is like $1 million.
Yeah.
Some people, $1 million is like Burger King pocket change.
Yeah.
Right? So it's all relative to your perspective or to your outlook in general. But what is money? And that driver, money to him through further conversation was about 15 grand. So you think about it, if he had one of the problems that your friend had, right, he'd still be out $70,000. All of a sudden, I'm profitable goes to, I have to file for bankruptcy, or I have to take out another loan, which then increases my rate per mile because I have to pay that loan plus the interest, right? It's crazy how it all goes. But what do we got here? Adam Wingfield is doing amazing work in this space, helping carriers just say, well, I have to take this loss, but giving them the knowledge to make better decisions. Perfect. All right, my man, Dean, that was a great show. I apologize, everybody, for the technical difficulties, but Dean, you rocked it, man. You filled that space while I was taking my nap, so it's good. We're ready to go.
That should be the screenshot That should be the image, that the screenshot you capture for the promo is you
Yeah.
asleep and wondering what the hell's going on.
Yeah, data day Wednesday, Dad's sleeping. Nice. No, we'll forget that. Thanks,
Right.
everybody. Have a fantastic day. Dean, enjoy the show that you're at today, and
Thank you.
I hope everything goes well, my friend, and we will chat soon.
All
Take
right.
care, everybody. Have a
Thanks, everyone.
fantastic day.
All right.
Centurion Trucking, our motto is people before profit. Today's market requires more transparency, consistency, and focus on what our clients need to win. Centurion Trucking and American Logistics are poised to help their clients achieve and surpass their targets. If you're looking for a team that honors your needs, dreams, and aspirations, then get a hold of Daman at American Logistics or